Hi, everybody. I'm Steve McDonald. This is your 2-Minute Retirement Solution. Well, he's back, Evan Balaga, direct from Hawaii, to answer the over 100 questions that we've gotten from people from his last visit here about long-term care, combining that with life insurance and how it's cheaper, more reliable, more money. I mean, for me, it answers all the questions. Evan, thank you so much for taking the time to be with us.
Hi, Steve, and thanks for having me on your show.
Don't tell me what the weather's like over there.
Sunny and warm, no East Coast snow. Thank you.
Okay, great. The first question I want to do is let's do a real quick review, just a couple of seconds. What we're talking about is long-term care combined with a life insurance policy. If you don't use the long-term care benefits, it acts as a death benefit. Is that correct?
Exactly. That is 100% correct. And it's technically a chronic illness rider. It's not technically a long-term care rider, but everybody knows it as long-term care. It's the same exact trigger as long-term care. 2 out of 6 activities of daily living. You then qualify to draw up to $10,000 per month for any purpose, not just long-term care expenses.
Now, one of the questions that came up, we had a lot of questions about this. What do we have?
I know.
You had like 60 or 70. I have like 30 on my email. One of the questions that came up is, if you don't use it, though, you get the whole life, you get the, the whole value, but the benefit that you get for the chronic illness or long-term care is the total value of the life insurance policy. Is that correct?
That is correct, at the rate of up to $10,000 a month.
Okay.
Technically, it's $9,900 per month. I'm just calling it $10,000 a month.
Okay. Now, what about illness, health, and age? One of the questions I saw was, as we age, does the cost of this go up, or how does the premium adjust?
When you purchase the policy,
right,
you pick the number of years or an age you want the policy to run, and the premiums will be guaranteed never to increase. So if you come to me and say, I want coverage for $100,000, $500,000 of benefit, and I want to be able to draw that out for long-term care, I want to have it a death benefit, I said, first thing is, how long do you want the coverage to run? A lot of people go, I don't know, 80, 85. Some people say 90. Some people say 95 or 100. I say, fine, then we can design a policy to go to exactly the age that you want, not waste an extra penny.
Right.
The premium's very flexible, but the premium that you select will never change. If you decide along the way that you're going to live longer or not live as long,
right,
you can adjust the premium. It's very adaptable, so you can adjust as you go.
Oh, that's interesting. Now, one of the other questions that came up, how much of an issue is health in this? Do you have to have
is a great question. I have had clients who will not qualify for long-term care insurance.
Okay.
But they will qualify for this policy.
Okay, whoa, that sounds like a good one. That's something I never even considered. Tell me about that.
Had a client who's got medical issues. The long-term care insurance companies are going, no way, we're not touching them. I applied for life insurance with the extended care rider, and he qualified. We put $1.5 million benefit on him. He's ecstatic.
Okay, let's talk cost now. You quoted a number for age 55 if you do that. Most people haven't done this. What happens to the cost, the premiums at age 60, 65, let's say, if people have waited too long? Is that too long, I guess, is the first question.
It's respectively lower in almost every situation.
Lower than
having
what?
Having the long-term, buying life insurance at 65 or buying long-term care insurance at 65, the life insurance is going to be less expensive.
Okay.
There's no question. Long-term care insurance is...
It's prohibitive.
It's prohibitively expensive. The premiums are not locked down. They will continue to rise.
Right.
And it's a very restrictive benefit that can only be used for very limited purposes.
But now this life insurance and the chronic illness rider that you're talking about takes care of all of that. Is that correct?
That's it, right.
How, that doesn't make, you have to explain this to me, Evan. If I were running the insurance industry, why would I offer these plans when I could hook people on the long-term care and the higher price?
Long-term care insurance, the jury's still out. The policy is still finding its legs. The claims, as you see, are going through the roof. There's a lot of consolidation amongst the carriers. The rates are going up. It has to morph again. Long-term care insurance used to be a not very likely event.
Right.
It was a low probability event, and it's morphing into a high probability event. So it's becoming so expensive that 2/3 of the policies that are being sold only pay for 4 years or less.
Right. Right.
And
Well,
the clients are effectively
yeah.
insuring the early years and self-insuring the later years.
Right. Where you're probably going to need it.
Folks with long-term dementia and Alzheimer's, they're living 7-10 years.
I know. It's a very tough situation. Here's another question that came up. Taking a traditional whole life policy and converting it to this insurance, this life policy that you talk about with the chronic care rider.
Well, that's a good question. The life insurance can be rolled over. These policies are so adaptable. They're actually on a universal life chassis, so you can make irregular contributions. So you could roll over an old whole life policy's cash value into this, do a 1035 exchange, avoid all the taxable gain. You can drive your premium down. In essence, you're making a down payment like you would on a mortgage. When you buy a home, you put 50% down, your mortgage is going to be lower. So if you have an old whole life policy that's no longer efficient, or an old universal life policy with cash value that's no longer meeting your needs, you can roll it over into this. You have a life insurance benefit, and you have a long-term care benefit. Your premium will reflect the amount of money that you put in.
So you're telling me that the health requirements are less than they are for just a straight life insurance policy, or at least that's been your experience.
They are less stringent than on a traditional long-term care. When you apply for this product, they underwrite you two ways, for life insurance and for long-term care.
Okay, but then the
long-term care issues are physical impairments.
Right.
Longevity are life insurance constraints.
Right. Interesting. That's just fascinating that it works out that way. The second point then would be that your premiums never increase, and the value that you have in the policy, either the death benefit or the total long-term care benefit, never changes. Is that correct?
Right. And if you want to increase your premium contributions, you can use it just like an income for life, private banking, whole life policy. You can use it identically, except there's a lot more liberal withdrawal provisions available than in the traditional whole life policy.
One other question came up. Do you have to be married? You quoted a number the last time you were on for a married couple to use this. I think it was $350,000 in coverage. Both could draw from that if both needed long-term care, which is normally not the case, I understand. Normally the first one is cared for at home, the second one has to fend for themselves. But what about a couple that isn't married? Because I know a lot of people here in Florida who can't get married because of estate issues, taxes, Medicare, or not Medicare, but Social Security. What happens there?
There's no benefit to being married when you purchase these policies. These are individual policies that each person has to qualify on their own. Some long-term care insurance policies will offer a married discount because they realize that once you're married, you have somebody in the house to help take care of you. Some of the carriers will reflect that in a reduced rate. Okay. Here, and then long-term care policies, sometimes they will hook them together so you could use your benefit and your spouse's benefit. So the first one who uses it wins, and the second one, like you said, may be left without coverage.
Right.
Here, each person has their own policy, their own respective benefits that they can draw from, and whatever's not drawn at the time of death will pay a respective lump sum value to the named beneficiary.
I can't imagine that you aren't selling these things faster than they can be printed. I mean, it sounds like it answers. I'm not joking. It sounds like it answers all of the issues that I have had.
I've had over 100 requests, so it's going off the hook.
That's great. Anything you'd like to add to summarize what we've been talking about?
Well, it's important that you look at what these policies can do in light of your overall financial circumstances. You have long-term care, you have life insurance. It's meeting both those needs. A lot of people have put in policies years ago that need to be reviewed and understood and determined how well they're going to perform going forward. Strategies are in place available these days that can really help you generate the income necessary, take care of your retirement, and certainly take care of these policies in a more efficient way than people have understood in the past.
Interesting. I mean, it's fascinating that they've come around so quickly in just the last 5 or 6 years. It's fantastic.
And you're going to see the long-term care business change away from the present model. It has to. It's no longer efficient.
Yeah.
People are grossly underinsured.
Right.
They're not covered properly on those policies.
Well, Evan's email address is on the screen now. Send him your questions. He's out there to help any way he can. He's one of our Pillar 1 partners. He's been there for years. Evan, thank you so much for being with us today.
Thank you, Steve, for having me on your show.
It's my pleasure. And for everybody here at the 2-Minute Retirement Solution, get some coverage. It sounds pretty cheap to me, to be honest with you. I'll see you next week.